Hi, I'm Mark Farber, and this is Fundamentals of Accounting. We're finishing up with our adjusting entries, and today we're going to look at accruals. Now, there's a whole bunch of accruals. It's a very generic term. Remember, this is accrual accounting, so it's all about accruals. We're going to look at one type, which is salary payable. You see the same sort of thing with interest. You see the same sort of thing with revenue and other things. But here's a particular example where we see this a lot. Every company has to deal with this in virtually every financial statement that it prepares. And that is that we, again, want to match up our expenses, in this case salary expense, with the period in which they were earned. And so we have a company that has a weekly payroll of $5,000. So the cost of its payroll for all of its employees every week is $5,000. And they pay that payroll out every 2 weeks. So in a particular year where January 1st falls on a Thursday, and they pay every second Thursday, the first payday is going to be January 15th, and they're going to pay $10,000. Then on January 29th, 2 weeks later, the company will pay out $10,000 of salary. And then 2 weeks later, on February 13th, they pay out another $10,000. So from an employee's perspective, that's fine. Every 2 weeks, they get whatever their share of that payroll is. But from the company's point of view, they have a month end on January 31st, and they want to prepare a financial statement for January. And on that financial statement, they need to record how much salary expense they incurred during the month of January. So this portion of the expense from January 1st to January 15th, that $10,000, that was all paid for and expensed in January because they got the benefit all in the month of January. Over here we have another amount that was paid from January 16th to January 29th, all within the month of January. But then there's 2 days left at the end of January. We have January 30th to 31st. And as of January 29th, those have not yet been paid. But people have worked, they've earned salary for those days. The company owes them that, and they receive benefit of having people work for those 2 days. So that expense has to be recorded in the month of January, and that's what we mean by an accrual, making sure that we get the expense into the right time period. So what do we do about these 2 days? Well, we know that they pay $5,000 a week for total salary, and if we assume that's over 5 days, it would imply that they pay $1,000 a day in salary. $1,000 a day times 2 days, because we're dealing with January 30th and 31st, would mean that they're going to have to pay out $2,000 of salary, or they incurred $2,000 of salary expense. And so what the company will do is on January 31st, it will debit salary expense for $2,000. And that will go on to the income statement as an expense in the month of January. Of course, they're not going to pay the employees the $2,000 yet. They don't have to pay them until February 13th, the next payday. So they'll create a payable. And a payable, just like an account payable, is just a liability account that means that we have to pay somebody some amount. And in this case, they'll call it salary payable, meaning that the company owes employees $2,000. So on the income statement, we'll have the $2,000 of salary expense added to the $20,000 that's already been expensed on the 15th and 29th of the month. So there'll be a total salary expense of $22,000 for January. On the balance sheet, it will show that the company owes its employees $2,000. These amounts here, this $20,000 has already been paid to them. Now, what's going to happen on February 13th? Well, on February 13th, the company is going to pay its employees $10,000 in aggregate. But it doesn't have $10,000 of salary expense in February. Remember, out of this $10,000, $2,000 of it was pulled expense-wise into January. So on February 13th, we're going to debit salary expense only for the days that were worked in February, of which there'll be 8 work days if we assume that 2 work days were worked in January. And 8 work days at $1,000 a day means that salary expense for February is going to be $8,000. Of course, the company also has to pay out its employees. Remember, it owes them $2,000. It's going to pay them now. So we're now going to debit salary payable, $2,000. And finally, we're going to credit cash, $10,000. So from the employee's point of view, all they know is that they got their regular payday here of $10,000 on the day it was due, February 13th. From the company's point of view, that $10,000 consists of $8,000 of expense in the month of February and $2,000 of expense in the month of January. And notice that this salary payable, this is the accrual account. We can think of it kind of as a holding account. We loaded it up with $2,000 at the end of January, and then we cleared it out. Here we credited it, here we debited it. So if we debit and credit an account by the same amount, it ends up being 0. So we've zeroed it out, and we've now paid out the employees. And we see, as I say, the same sort of thing happens with interest, where interest is earned or expensed in a certain period, and then the payment of the interest might happen a little bit after that or sometimes before that. We see it for all kinds of accounts where these payables or receivables, depending on if you're paying or receiving the money, are set up and then cleared out, usually within the next, sometime within the next accounting period. So that's the end of the adjusting entries that we're going to look at. What we're going to do next is start to get ourselves ready to prepare the financial statements, which is the goal of financial accounting, of course.